Well, greetings, my beloved clients and friends. Today is July 7th, 7/7. Hopefully, it's a lucky day. So, just wanted to talk about markets, last quarter, inflation, and the R word. So, last quarter was brutal. It was, I think, the worst quarter we've had, at least going back the last decade. It was rough, so I'm not going to sugarcoat that. Um, Fed Chair Powell started raising rates and aggressively, and it really wreaked havoc on the equity markets and the markets and the economy as a whole. So, and the big trigger in June, that in the May inflation read came out really hot, and so Powell had to act very aggressively, and oil had shot up to like $123 a barrel. So inflation was it was not cooling off, it was not peaking. So, and we've said that we're keeping a very close eye on the price of oil, and if oil continues to rise, there's really not much Powell can do to stem inflation, besides bring massive pain. And even with the massive pain, it's hard to stop inflation when oil keeps going up. That being said, oil's been coming down. It peaked at 123, and since then this week it went even under $100 a barrel. It's back a little bit above 100, but the July 4th weekend is like the peak weekend, and the summer is the peak season. And we kind of got through that July 4th weekend without a massive spike in oil prices and gas prices by extension. So that's somewhat encouraging. The commodities markets have been coming way down. Oil being the biggest in that commodity, but copper and other things, lumber, all those commodity prices have been coming down. So it seems like the priority of fear has shifted from inflation to recession, and prices are coming down. The housing market has cooled from being white hot, like it was just 2-3 months ago. I mean, even April, May, housing market was still just white hot, and it's cooled substantially with the rise of interest rates. Interest rates even have come back down. They had shot up over 6, and now I'm talking about mortgage rates, about 5 3/4. So they've come down. The long-term rates also they shot up on these inflation fears to about almost 3.5, and they're now back down under 3. So maybe we might be turning the corner on inflation. And Powell even acknowledged that the threat of raising rates is as powerful as raising rates. Like Teddy Roosevelt said, speak softly and carry a big stick, right? He just showed that he was carrying a big stick, and the markets kind of got the message. And so it's possible that when we get the read for June inflation, that it's come down quite a bit. Now, I want to make sure that we're focusing on the month-over-month inflation, because that's where you're going to be able to tell if inflation's moving. Because, just give you an example, let's say inflation, the reading of an index of prices, let's say it's 100. Next month, that reading of a basket of goods goes from 100 to 101. That would be 1% month-over-month inflation. That's what they look at. They look at what's the value of this basket of goods compared to what it was last month. And let's say for 12 months, for a whole year, it keeps going up by 1. So it goes from 1 to 101 to 102 to 103 to 112. So that would be over the course of a year, inflation was up 12%, right? Because it went from 100 to 112. So now, let's say the Fed takes action and somehow it miraculously stops inflation. So next month, the reading is 112. Again, that means it went from 112 to 112. It stayed flat, no more inflation. So the month over month reading would be 0. But the year over year reading would be, a year ago it was 101, now it's 112. The year over year reading would still be 11. The next month, no more inflation, it's still 112. So the month over month rate would be 0. But the year over year rate would be from 102 to 112, it'd still be 10%. So that year over year rate isn't going to get back down to 2% overnight. But the month over month reading could go to 0 overnight. It could even go down. Let's say he tightens and too much, and then the month over month goes, that next month goes from 112 to 111. That's actually deflation. But if you compare it to the year over year, from 103 to 111, that would still be 8% inflation. Okay, so don't get too caught up, and the news is going to want to give you the more exciting number, which is it's still 9% or it's still 8%, right? Don't get too caught up in that. If we see that month over month number flat or very low or lower than expected, those are all good signs and an indication that Powell won't have to raise as much as he said he would. Right? He said he wanted to get to 3.4% by the end of the year, when it's at 1.5 right now. So he might have been just saying that to show, hey, I got a big stick, and it might have worked, and he doesn't even have to do it. And if he doesn't have to do it, the market's going to breathe a sigh of relief, and we could find a bottom, okay, and start turning around. So that's why we're keeping an eye on the oil prices, because of its effect on inflation. Now, let's talk about oil price a little bit more. Now that we brought up the R word, since 1955, there have been 9 recessions. And let's define what a recession is. It is 2 consecutive quarters of declining GDP growth. Okay, so GDP is a gross domestic product. That's basically, if the United States was one corporation, if all the corporations came together to be one, what was their output for the quarter, and how does that compare to the previous quarter? And surprisingly, in the last 65 years, it goes up almost every quarter over quarter. It goes up, goes up, goes up. There have only been 9 times in that 65-year period where there have been times where it went down for 2 quarters in a row or more. Okay, so it's an amazing testament to the strength and durability and stability of the U.S. market, that in 65 years, that's only happened 9 times. And so that's average of about every 7 years or so. So we had one in 2020 when COVID hit, and then before that was 2008. So, you know, there might, it wouldn't be surprising if there was one. And so I fully expect there to be a recession. Let's get that question out of here. Are you afraid there might be a recession? No, we're probably already in one because the first quarter of this year, January, February, March, showed declining GDP. So, and we finished the second quarter. And so if we get declining GDP again this quarter, we might already be in one. The books have closed. They just have not reported the number yet, right? June 30th, the quarter ended. So that might be officially the second consecutive quarter of declining GDP growth. If it's not, I fully expect there to be, in the short term, 2 quarters of declining GDP growth. Why? Well, here's why. Like I said, for the last 65 years, with only a few interruptions, the U.S. economy has steadily increased quarter over quarter. Okay. Then in 2020, there was this massive shock, which was COVID, and they shut down the economy. They said you couldn't leave the house, you had to social distance, you had to wear a mask, you couldn't go to school, you had to work from home, you couldn't go eat at a restaurant, right? Of course, you're going to see a massive shock and a massive drop in GDP when that happens. And the result or the reaction to that was the Fed and the governments had massive cash infusions, right? They sent people checks to their house that had lost their job. They sent checks to businesses so they continued making payroll. And guess what? People realized, I'm still getting money. Not everybody, but a lot of people substantially were still getting money. Some were even getting more than they had been getting. And they had no place to spend it. They couldn't go travel or anything. So the resilient American consumer figured out how to spend money from home. They could shop online and they could spend money from home. And by the way, if they're going to be at home, might as well upgrade the house. If they're going to spend time there, build an office, or if where you're at doesn't facilitate building an office, go buy a bigger place. Go move to the suburbs. Go move someplace where the weather's better or the prices are better, or you get a bigger place. So there was a massive uptick in retail spending, in particular online retail spending, massive activity in the housing market and ancillary markets. And the economy recovered radically, right? So it was this massive shock down, this massive bounce up, right? This big oversteer down, you could call it, right? Shut down everything. This big oversteer up, give everybody money, right? And what do you expect? There's got to be one more correctional steer to get you back on track. The risk is that they're going to oversteer for the third time. But if they could just do this correctional steer and get us back to that steady, consistent growth, that would be considered what they would call a soft landing, right? But there has to be some third correctional steer. So I'm not concerned of the fact that are we going into recession? Well, one, the answer is yes. Two, is that a bad thing? No, not necessarily. It's just something that needs to happen, and it's just a reaction to the 2 previous shocks. The question is, what will be the length and severity of the recession? The question is not will there be one, it will be what will be the length and severity. If it's a short, mild recession, no problem. We needed it anyway like I said, that correctional steer. But if it drags on for a long time, or if it's if it comes down a lot, right? That would be the concern. So don't worry about, right? The headlines are we going to be in a recession? Of course. It's only natural after what we've been through. The question is, how long will it be? How severe will it be? So let me give you an example. If it's only 2 quarters and it's only down, 0.1% or 0.5% or something like that, that's not that big of a deal considering what we've been through. But if it extends longer than 2 quarters, if it and it's more severe, it's not just a -0.1, it's a -2 or something like that, then that would be the cause for concern. So I think everything that's happened in the first half of this year has been, to some degree, a cup of water in the face, a sobering up of this, and a needed sobering up of an economy that was really, and markets that were just out of control. Stuff was overpriced. The housing market was white hot. Like even like watches, the price of those things was just going up to ridiculous heights, and that market has been correcting too. So and the salaries that some people were getting because the market for labor was so tight was outrageous. So there needed to be some sobering up, some level thinking coming back into them. And I think at least in the stock market, analysts are looking at things more soberly now, which I think is good. Kind of to think about what happened in the run up to the 2008 housing crisis, that bankers, lenders were just giving anybody a loan, right? If you could fog a mirror, you could get a loan. And well, that didn't make any sense. Bankers are supposed to be sober and disciplined, and they got away from that, and there was a needed correction. Well, a similar thing has been happening in the stock market. The prices of in the private equity area and in the riskiest, growthiest sector of the market was just really high. And so there needed to be a sobering up. And I think that has effectively occurred. The grown-ups are back in the room, if you can say. And so I'm not worried about the recession. I am still, the verdict's out, and what will be the length and severity of it. And I think probably if there's anything I'm worried about, it's the war, which in my opinion is an unnecessary war, but it could wreak havoc on the energy markets. When it starts getting cold in Germany and they're dependent on Russian oil, what are they going to do? And what's that going to do to the oil markets? And they're a big, Russia and Ukraine are both big suppliers of food to the third world. If there's a food shortage in the third world, how will that affect? And so I really wish there was a resolution to this war, because that's the wild card. So I think it's keeping the market in check from a big bounce up. I think we will have, if inflation numbers come in pretty good, I think we could have kind of maybe had a nice turnaround to this market, but I don't expect it to shoot up dramatically. I mean, a nice recovery off the lows, but not crazy until there's some resolution to this war. But those are our thoughts on where we are and how we're positioning. So we're not buying with both hands. We're raising cash and we're being cautious. But as opportunities arise, we'll try to take those. And as risks arise, we'll try to protect against them. Okay, so hope that helps. We're trying to do our best to stay on top of things, and feel free to give us a call if you want to discuss it any further, have any questions. All right, have a great day.